Good afternoon. The webinar today is entitled A Contrarian or a Bottom-Up Approach to Investing. So in this webinar, we're going to discuss three investment strategies, which I think is almost the same. Firstly, we'll be discussing a contrarian investment strategy, which is the buying of poorly performing shares and then selling them when they perform better or perform well. That's number one. And number two, next, we'll be looking at or touching on what I call the bottom-up approach to investing, as opposed to a top-down approach, and that will lead us into value investing, which is related to contrarian investing, as both strategies are looking for mispriced shares and buying those shares that appear to be undervalued by the market. And I'll be touching on it a bit later, but how do we know the shares are undervalued? A value investor identifies buying opportunities by using certain financial, call it metrics, such as the PE ratio or the PEG ratio or the price NAV, to help you make a better informed decision. So that is my objective today, is to introduce those three concepts to you. So let's jump in by first looking at what is a contrarian investor. Okay, quite a few more people coming in. Awesome. Well done. Cool. So, what is a contrarian? Okay, what is a contrarian? Contrarian investing is just an investment strategy that is characterized by purchasing and selling shares that are in contrast to the prevailing, call it market sentiment at the time. In other words, you're going against the trend, or as we would say, going against the herd. And one of the better ways of looking at that is a quote from Warren Buffett. And I think he sums it up best. What is a contrarian? Says, be fearful when others are greedy, and greedy when everyone else is fearful. You know, if those of you who don't know who's Warren Buffett, he's one of the richest men in the world. I think one of the most successful investors worldwide. So a contrarian believes that investor behavior, certain investor behavior can lead to exploitable mispricings in the market. And we'll go into more detail with that. For example, widespread pessimism about a share can drive a price so low that it overstates the company's risks on the one hand, but also understates its prospects, its growth prospects for returning to profitability. In other words, the market has written off this company. Okay, so everybody's ignoring it. So as a contrarian, you want to exploit those opportunities. So by identifying and purchasing these distressed shares and selling them when the company recovers will lead to obviously above average gains. But saying that, have you ever heard of the saying? I'll be talking about a lot of market cliches, catching falling knives. So let's look at some examples, and obviously some of you guys might realize or recognize some of these stocks. So yes, in the top left there, we've got Steinhoff. Okay, this is showing the long-term graph of all these shares. You've got Steinhoff in the top left, you've got the bottom left, you've got EOH, it's also come off a lot. And then you've got shares like Basil Reed and Aveng that have also been knocked heavily. Okay, so I'm going to use these as examples. And the reason I brought these up, because we come across it all the time here at PSG, where the clients are phoning in or they want to buy into these shares. And this is where the risk comes in with regards to investing. And I think, people must understand I always say there's five things or five mistakes that novice investors are making. Number one, they must understand that investing, don't confuse gambling or speculation with investing. If you're acting on a hot tip or just blindly buying a share, you're not investing. Investing means you're making a decision that you're comfortable with, number one, and number two, you're prepared to stick with it for a while. That's an investor. Okay, so when I say catching falling knives, bottom line, if you're not doing your homework properly, you're going to get hurt. Okay, so, and also some of you, there's a lot of regulars on this webinar. Some of you have heard me say this before. Hope is not an investment strategy. You buy something now and hope it will recover. Okay, so I want to show you a more, call it scientific way of investing in the market. Okay, so that's number one. Investing does not equal gambling. Number two is research is key. Yeah, but most of the novice investors are not doing enough research. When I say enough research, is, you need to understand what you're getting into. What is the products they're doing? What is the service they're doing? Do a bit more homework on the company. And that's the point. Do your homework. Don't just go blindly buy the share. And then the third, I think the biggest mistake a lot of people are doing is they go the cowboy approach. They're not looking at the risk. So, do not lose sight of your risk tolerance uh, or your capacity to take on risk. If you're a sort of investor who can't stomach volatility, especially with these kind of shares, and when I say volatility, I mean the multiple ups and downs that you'll be finding on the stock market, you're better off investing in a unit trust investment where a fund manager will be picking the stocks for you and you have a bit more of a longer term approach, as opposed to picking the stocks and then building up a well diversified portfolio. So the idea is also you want to bring in, you want to balance the risk and the return. A lot of people, they're expecting to make a great return when the share bounces back, but that high return comes with high risk. If an investment offers a very attractive return, but also you just look at the risk profile of the company and see how much money you could lose if things go wrong. So yes, some of you guys have been putting in a few rands into the shares, but some of you have been putting a lot of money to the market. I know some people have been buying Steinhoff on all the way down, and it's going to take a long time before you break even. So saying that also, a lot of novice investors do not diversify. They're putting all their eggs in one basket. Diversifying is a way to avoid overexposure to one investment. So having a portfolio of making up different shares is one way of obviously protecting yourself against volatility, but also extreme price movements. So bottom line, what I'm trying to show you with all these graphs here, do not be fooled by low prices. Just because you're able to buy something at a low cost doesn't mean it's a good investment. Investment is about finding value, and we're going to that in a few slides' time. A high price share could still offer value in terms of prospects for a return. So in other words, a 500 Rand share is cheap relative to its profits or its earnings. And a 50-cent share can be expensive relative to its earnings. Okay, so that's just as a call it an introduction to what I want to talk about. So that's looking at falling knives. You look at the opposite. So here we got widespread optimism results in unjustifiably high valuations that will eventually lead to price drops, and obviously especially when those high expectations don't work out. So yeah, I've got NASPATs and I've got clicks as examples. I'm not saying that they're overpriced and things like that, just that these things have been flying. So you can see my top right hand corner, what I'm trying to highlight here. Are you a momentum trader or growth investor? Now, if you're looking at if you're a value investor, you want to avoid investments that are overhyped, number one, and also, in anticipation that these prices might pull back. Rather avoid these stocks. Okay, so let me introduce the concept of what I call a bottom-up approach. A bottom-up approach just focuses on identifying companies that are, as opposed to looking at the whole market, we're looking at individual shares. That's what I call a bottom-up approach. So what you're trying to do here, as opposed to a top-down approach, where we're emphasizing the economy and then the market cycles. So you're looking at the bigger picture of a top-down approach. Bottom-up approach, where we want to focus on today, I want to focus on shares that have opportunity for growth. In other words, you want to find companies that are doing well in an industry that's not doing so well. Okay, so we'll show you some examples just now. So a bottom-up approach, we'll look at macroeconomic factors. When I say macroeconomic factors, the nature of the business itself, more specifically the company's financial statements, as opposed to a top-down approach where we're looking at macroeconomic factors. What factors would affect the economy, be it inflation, be it interest rates, labor, whatever the case might be, okay, exchange rates. When we talk about bottom-up approach, as I say, it's more the company's financial statements, the nature of the business, etc., the management itself. And then lastly, as I say, we're looking at a specific company rather than an industry, and then we obviously want to find the best share within that industry. That's what a top-down approach would look at. I'm looking for looking at economy growing well, and then hopefully the economy is growing well, industry is doing well, and then the best opportunities within the industry. When I say industry, I'm focusing very broadly on financial shares, industrials, and then mining and resources. Okay, so today I want to focus on, as I say, the bottom-up approach, and that leads me on to the next one, what we call value investing. So value investing is very simple. It doesn't require any extensive background in finance, although understanding of the basics will definitely help you. If you have common sense, patience, and money to invest, and the willingness to do some reading, okay, you can become a value investor. And I think Warren Buffett, again, best explains value investing by this little quote here. Price is what you pay and value is what you get. So that leads me into 5, call it fundamental concepts around value investing that will help you understand it a bit better. So first of all, you must understand that companies have intrinsic value. What do I mean by intrinsic value? You might look at the share price, as I mentioned just now, 500 Rand share can be cheap, okay? But what is its true value? It's a real value. And in the market, we call it the intrinsic value. So intrinsic value, when we talk about here, and as I said, it's just common sense. You'll be doing it already on a regular basis. The idea is that you know the true value of something. You can save a lot of money if you buy it on sale. In other words, value investing is bargain hunting. So I'm going to use an analogy. So most people would agree that when you want to buy a new TV, when it's on sale, as opposed to full price, okay, you're getting the same TV with the same screen size and the same picture quality. So it's better to buy it when it's on sale. That's assuming that obviously the value of the TV won't decrease with new technology coming out. So shares operate exactly the same way. The company's share price can change even when the intrinsic value is still the same. So that's based on supply and demand. So shares, as I say, will go through, like TVs, higher period where there's demand, pushes the price up, and obviously lower price when it comes down. So remember when I referred to Warren Buffett just now, price is what you pay and value is what you get. Okay, if the share is worth 100 Rand, okay, let me bring my little cursor in here quickly. If the share is worth 100 Rand, there's intrinsic value. It's worth 100 Rand, and you can buy it in the market right now at 66 Rand. Okay, you have what you call a margin of safety. In other words, you make a profit by simply buying it at a lower price. Okay, because the real worth is 100 Rand. So on top of that, if the share price goes up higher and becomes more valuable, okay, goes to 110 Rand, you're making 44 Rand profit. Okay, now if you had to buy it at full price, it's trading at 100 Rand, you're only making 10 Rand profit. Okay, so that's why you want to buy into what we call the margin of safety. And that's my next point I want to bring up. Warren Buffett's mentor, some of you guys might know him, is a guy called Benjamin Graham. He's regarded as the father of value investing. He only bought shares when they were priced at 2/3 or less of the intrinsic value. So look at the scenario here. Imagine if you're buying the share at 34 Rand, but they're actually worth 84 Rand. Okay, same thing here. So that's what value investing is all about. Trying to buy shares that are undervalued and you've got more space, more upside potential to make a big profit. So let's bring the next criteria. Always have a margin of safety. So if I'm buying the share and it's cheap relative to its real value, as I say, I'm making a profit, number one, but also I'm less likely to lose money if the share doesn't perform as I hope. Okay, so that's what I call by margin of safety. And the third concept you must understand when it comes to value investing. Value investors do not believe in what they call efficient market hypothesis. In other words, share prices do not reflect all the information about the company. Okay. The idea is that the share price and the value are two different things. Never buy a share on price, you buy it on value. Okay. And then lastly, second lastly is successful investors do not follow the herd. Sound like there's a problem with the sound. You guys still okay with the sound? Okay, cool. Okay, so successful investors do not follow the herd. In other words, okay, remember we're contrarian, where we else is selling, we want to be buying, and vice versa. But okay, we look at certain numbers to help us determine when to buy and sell. And then, as I say, value investing is is a long-term strategy. It does not provide instant gratification. You can't expect to buy a share today at 66 Rand and sell it next week Thursday at 100 Rand. Okay, it's take a bit of a longer term approach. That's number one. And number two is that you might have to wait for these investments to pay off. When your boss is ignoring them, you have to wait for everybody else to cotton on to the idea that the share is undervalued. The good news is that the long term, if you decide to sell it down the line long term, capital gains tax applies, which is obviously much lower than income tax. Okay, so let's talk about valuation. How do you know if the share is undervalued and things like that? So the idea is that the common practice for most investors, we use what they call a price to earnings ratio, or they refer to as PE ratio, or a price multiple. And they use that to determine if the company's share price is overvalued or undervalued. So as I said just now, if a share is undervalued when it is trading, a share is undervalued when it's trading below its true value. Okay, mention again, a 500 Rand share is cheap because it's worth 750. Okay, or 50-cent share is expensive because it's only trading on, for example, it's trading at 18 cents. So a 500 share has good prospects where a 50-cent share could not have prospects, and that's where the speculation comes in. So the difficulty is knowing what the true value of the share is, because everybody will have a different opinion. So analysts will obviously recommend undervalued stocks with a strong buyer recommendation. So here's a quote from John Slater, and he's regarded as a father of what they call the PEG ratio. And we're going into more detail now. Any company on a very high PE ratio is living on borrowed time as far as market rating is concerned. Sooner or later, the growth rate will slacken and the PE ratio will fall to a more normal level and then to the average and then below it. So you'll find that companies with a high PE ratio are typically the high growth shares, like the Naspers and things like that. However, the relatively high multiples do not necessarily mean that their shares are overpriced, nor does it mean that they're good buys for the long term. Okay. The point I'm trying to make here, you have to look at the PE ratio. What are you looking at? The PE ratio, and the ratio stands for the current share price divided by the earnings per share. So there's two components that make up the PE ratio, the current price and the earnings. So earnings are very important to consider. After all, the earnings represent the profits of the company, and which is what every business strives for. So the problem with the PE ratio is that it uses the past 12 months earnings, which does not give an accurate reflection of its growth potential. So it's the relationship between the price earnings ratio and its earnings growth will tell us a more complete story than just on the PE by itself, and hence the PEG ratio. So the PEG ratio is more widely used indicator of the company's share potential. So it's favored over the PE ratio because it accounts for growth. So here we've got a scenario where looking at two shares that I mentioned just now, a lot of people will go look at price. One share is trading at 1 Rand, other one's trading at 2 Rand. A lot of novice investors go buy the 1 Rand share because it goes from 1 Rand to 2 Rand. I've doubled my price. Don't buy share on price. You want to look at value. So here we're looking at the PE ratio. In this scenario, both shares have a PE ratio of 15. Okay, and as I say, a lot of people revert back to the price now. But now you want to bring in the earnings growth. This company is growing its earnings by 30%, and this company is growing its earnings by 10%. So what you want to do is you want to divide the PE ratio by the growth, and this would how we calculate the PEG ratio. The PEG ratio in this scenario for share number one is 50%, which we consider as cheap. If you divide the 15 by the 10%, you get a PEG ratio of 150%, which we consider is expensive. If you look at the sector as such, the PE divided by the 20% growth, you still got a relatively undervalued PEG ratio. So the idea is very similar to a PE ratio. The lower the PE relative to the market average, the better. Same thing with a PEG ratio. The lower the PEG ratio, the better. Okay. So as long as the earnings growth rate is higher than the PE ratio at the time of investing, that's the kind of investment you want to look into. Okay, so that is a very simple way of looking at the PEG ratio. But saying that also, the PEG ratio is less appropriate for measuring companies with high growth, like the NASPASs and things like that. Large, well-established blue chip shares, okay, for instance, may offer dependable dividends, okay, but little opportunity for growth. And there's a saying on the market, another cliche, elephants don't gallop. So you'll get your 20% growth per annum from the share, and you get your 3% dividend yield. Those are the blue chip shares I'm talking about. Okay. Let's just move on to the next slide. And I've used this as an example just to, I mean, everybody has a cell phone, and everybody has a contract with one of these service providers, be it either MTN, Vodacom, or Telkom. Now, look at these scenarios this year. Yeah, again, looking at price, a lot of people go look at Telkom, was only trading at 48 Rand as opposed to 106 Rand and 125 Rand for Vodacom. Look at the PE ratios. So a lot of people look at the PE ratios now and say the average of the market right now is 19. So any stock, MTN, relative to the market on a PE ratio, will be trading what they call fair value. It's trading in line with the market. Vodacom slightly bit lower, and Telkom's at 9. Bring in the growth now and bring in the PEG, and this is where I think on our website there's a legend that'll help you to understand it a bit better. We color coded for you. Overvalued shares or on a PEG ratio will be anything over 126 on the PEG ratio. As I mentioned just now, fair value is anything between 176 and 125. Undervalued will be between 76 and 75. So if the cheapest, call it that, if you're looking at these three companies, would be your PEG ratio of Telkom, which is 88. Okay. There's other criteria you want to bring in also. So we talk about financial risk, and we talk about quality ratings. I'll touch on a bit later. So you'll find that that's what the stocks you want to focus on, the stocks that are undervalued as a value investor. Sometimes you find the stocks that are they've fallen so far, we highlight them as speculative. So there might be opportunity, but there's risk involved. You need to do a bit more homework on the company. So I'm going to look on to another one. I'm looking at food now, which is an example of food producers, Angloval Industries, Pioneer Foods, Tiger Brands, and Quantum Foods. So in this scenario, again, just looking at the PEG ratio out of these 4 companies, I'm just using 4 shares. I'm color-coded green, so you can see undervalued. So this will help me to do further analysis on the company. It's just highlighting for me that based on the PEG, Pioneer Foods has the lowest PEG, which is the undervalued stock. Most overvalued will be Quantum Foods. Goes back to what I said just now. A lot of people will go buy and share on price. So this has got the lowest price, but the most expensive or overvalued. Whereas Pioneer Foods is the cheapest, it's got a high price. Okay, so this just shows you that the disparity as such. And then just to sum it up quickly before we rush into questions and things like that, on our website we have a thing called Best Quants. So scanning the market right now, that is about 2 days ago, on large cap stocks, you can see there's 4 stocks that have met the criteria right now, and there's a lot of other criteria you want to bring into consideration. Remember, we've only been talking about valuation. We've been talking about the PE ratio, we've been talking about the PEG. You can also bring in the price NAV. Bottom line, when it comes to all these valuations, the lower the better. Okay, that's the first criteria. Secondly, you look at what we call profitability. So you look at things like the return on equity, and look at things like dividend yield. So return on equity, and here we look at the opposite. The higher, the better. Okay, dividends as a percentage of headline earnings per share, the higher the better. So all these are paying out on dividends. 53% of their earnings have been paid out in dividends. Okay, and then the last criteria you want to look at is manageable risk. So this is where we look at cash flow and we look at the interest cover. Okay, so again, anything apart from Liberty and First Rand, which are financial shares, other criteria apply. Most of these stocks have cash flow and interest cover that are applicable. Okay, and then quality rating. Lastly, you want to look at the quality rating. All these stocks have a quality rating above 60. Anything below 60, I'm worried about that. And that again brings into what we call sustainable growth. So all these companies have a good quality rating. You want to valuation and quality together. In other words, have the best of both worlds. So that's looking at best large cap stocks right now. And then our best small cap stocks, these are the best quant ideas coming up right now: ARB Holdings, Peregrine, and Spurcorp. Very similar, again, valuations. You can see that. These are all relative to all the shares in the market. These are just highlighting 7 shares for you that might be opportunities for you to do further investigation. So here's my disclaimer. These are not tips. It's just a highlight for you the ideas I've spoken about and using value investing. Okay, so quickly, summary and conclusion before we handle any questions. Okay, are you a bullish contrarian or you're a value investor? I believe they're both the same thing. Bottom line, you're a bargain hunter. But use those metrics I spoke about earlier on. And by the way, there's a whole lot of tutorials on our website, goes into more detail, how to understand those metrics a bit further. So remember, as a value investor, you're a bargain hunter. And then bottom line, what I suggest what you do is create a watch list of the potential winners. Scan the market using the value investor to help you look at valuation, profitability, and risk management. Okay, so guys, from my side, I hope you've learned something today. As I said, the recording will be emailed to you soon. Please share the recording on social media. Okay. And then from our side, good luck and happy investing. So before I hit the questions, just to say, remember, here's my disclaimer. I'm not a financial advisor. I'm not giving any investment advice. It's here for education purposes only. There's my contact details. Drop me an email or phone me. Any questions you have, I'd love to converse with you. And talking about conversing, let's look at some questions that you guys might be having. Okay. Cool. Okay. That's a good question. Yeah. Is a dividend yield the right way to evaluate value of a share? That's one of the criteria. You want to look at, as I say, the PE ratio, but what's better than that is look at the PEG ratio and then look at NAV. That's valuation. Dividends is just a bonus. If you're looking for income yield, income and things like that, and then look at dividend yield. That's one of the criteria. Okay. Jan says, please repeat the PEG calculation. Basically, it's the let me just go back to my notes here. Exactly what it is. The PEG ratio is the PE ratio divided by the forecast growth, the average growth over the next 5 years. So bottom line, what you're trying to do here is you're trying to select companies not only with a low PE ratio, but those companies with a PE ratio low relative to the EPS growth. Remember, Jan, this presentation we emailed to you, so you'll have the presentation. Okay. So you're trying to target better companies trading on low PEs. That's what the PEG ratio does for you. Okay. So I hope that answers your question, Jan. Pleasure. Cool. What other questions we have here? Yeah, Shaul, the EPS growth, and the idea is, yes, we do use a 5-year model. So the idea is that we look at our model on our website. We look at 3 years back, and we forecast 2 years forward. Okay, so I hope that helps you with the question. It's difficult for a private investor to do these numbers themselves. So use the tools on our website. We've done it for you already. Okay, I hope that answers your question, Shaul. So yeah, we're using a 5-year model. Cool. There's a question from Edmund. As an existing share trade customer, are we able to ask PH's opinion about certain shares? Welcome, Edmund. So, I'm not allowed to give you specific investment advice, but you find me say, Sean, I'm looking at the stock, what I think. You tell me the stock, I can go look at the fundamentals. I can also look at the technicals and give you some feedback. No problem. I'm there to help you. Okay. What other questions we have here? Good, guys. Cool. Pleasure, Edmund. Okay. That looks like all questions. Great. Guys, as I say from my side, thank you very much. All the best until our next webinar in August. Keep well. Enjoy the rest of your day. Bye for now.